Hello everyone. Today we are going to, I'm going to explain you like how to make a system. All right. And let me tell you, this is not for trading purposes, as I'm just making this for educational purposes. And why I'm saying so is because this system which I'm going to explain you, it's a random system that I have selected, and you can see that the drawdown has been in an increasing trend. Okay. So So let's start with like how I exactly ended up, creating this random system. Okay. So there is this first trade. This trade you're going to take on Tuesday, Wednesday, and Thursday. All right. And the stop loss is 100% for this. Okay. The 920, it's 920 entry, and every trade in these two exit will be at 1524. All right. So what is the stop loss for this particular thing? It's 30%. So these two are basically one strategy that would require almost 2 lakh as per the current margin, that is I'm expecting it to be 1.8 lakh. Okay, soon enough bank nifty lot size will be reduced to 15, and this is expected to come down to around 1.1 lakh. All right. So now there are a few repetitions here. Okay, let me explain you like what are the repetitions. So it's let me clear the screen. So you can see the same thing is written there, right? So it's 925, okay, 1100, 1240, 1420, and 1500. So what are these? Why is G written over here? Okay, and why is T written over here? So T stands for theta. Now let me before proceeding, let me tell you that I have a system very much similar to this what I'm currently showing you right now, but not exactly this. And I expect you guys to actually go and find that particular system which works for you. All right, this might not be working for everyone. Okay, so this G stands for gut. What is a gut? Now a gut is when you suppose market is somewhere like here, okay, and right here at the money is 40,000. Okay. Now this T, you will be selling a 40,000 call and a 40,000 put. But whenever it's G, you will be selling one ITM call and one ITM put. That is, if you go down, it's OTM for puts, right? If you go up, it's OTM for calls. But we are going to collect more premium, okay, by selling the in the money, just one in the money call and one in the money put. Okay, so this is put, and the downside it's call. Now, what is the stop loss in this one? The stop loss in this is 70 points. Okay, and all the trades will be reversal cost to reversal to cost. Okay, like the call is rising and it hit your SL, then the put will take a stop at the entry price itself. Okay, in this one, this one, this one, and this one, in all these trades. Okay, so let me now show you the results here. First, I will just show you the combined result. Okay, so this is how it looks like. Okay, in the monthly chart, I have also taken it down in this page. I'll come to this page, but before that, you can see that it has given zero loss month from 2021, and it was just a random strategy, okay, that I have created. And what is the capital required for all of this? If you would see that 1, 2, 3, 4, 5, 6, and 7. Okay, there are 7 trades, so you might be thinking like, okay, fine, it's 14 lakhs. Okay, but the thing is, these trades, okay, 925, 11, 12, 40, 1420, and 1500, these are one after another. Okay, let me explain you how. So this 925 trade will be exiting at 10:59. This 1100 will be exiting at 1239. Similarly, this will be exiting at 1419. This will be exiting at 1459, and this will be exiting at 1524. Obviously these two will exit at 1524 and 1524. Okay, so coming to the results, so this is the result, and the expectancy, the net expectancy of the system is 0.56. Now I have considered a slippage also, and I have considered like the drawdowns as well. So let me just come back to this page and let me start from zero. So there is nothing selected. Now hedge is required? No. I mean, if first we will consider that hedge you are not taking for, for margin benefits. Now let me show you with the first trade itself, just 920 straddle with 100% and 30% SL. 30% SL on Mondays. If you want, you can put this 30% trade on Fridays as well. Okay, but on Fridays those guts those guts will not work. All right, so what is the margin required for this thing? It's 2 lakh rupees. And what is the return on this thing? See, the return is 339%. That is, it's not like every year 339% or something. Okay, it's like over a period of how many years? It's like 7 years. It's 339%. That is, if you would have started with 2 lakh rupees, today you would have had like close to 8,77,000, but you have to give some charges also. So here are the charges I've written in small. Let me just make it a little bigger. So see, this is the charges. So 61,900 you will give charges if you do just this trade every day over a period of 7 years. Okay, now let me go ahead with the numbers. Okay, so numbers, what do they say? It says that margin required is 2 lakh rupees. Win percentage is 64%. Okay, it's not a very bad win percentage. It's a decent win percent that you have there, right there. The risk to reward is greater than 1. Very good. Now the max drawdown is a concern here. Okay, the max drawdown here is 20,000. That is 10% of your capital. Now you should not be running, a system which is having a maximum drawdown of 10% itself in the starting. Okay. Now, what is the expectancy here? 0.31. So expectancy is a number which, it's the higher the expectancy, the better the system will be performing in the longer run. So now let's go with the second combination. You have to, you have to look at these numbers. Let me color this to something important like red and make it bold, and let me keep it black and bold. Okay, so let me make it a little bigger. Now I will try the second setup, that is 920 with, again it's the same thing, 920 with 100 and 30% and 925 delta trade ITM gut with 70 point SL. Okay, now you see the margin required has gone up. It's like 2 times because now you are taking 2 trades in parallel. Okay, now if I'll just go back to 1, what was the return percentage in this thing? 339. And if I go back to 2, what is the return percentage? Now it has reduced. Okay, now you are giving, you are giving back some returns in order to make your strategy better. Now which all has become better? This 1.19 has become better. Okay, now maximum drawdown has reduced from 10% to under 5%. See, the biggest change it has come here, and the expectancy has started to rise from 3.1 to 3.9. The hedge is not yet required. I mean, I'll just show you once, but I will be not considering hedge throughout. So if you take hedge, your margin requirement falls from 4 lakh rupees to 3 lakh rupees. Okay, and like everything changes, like your drawdown increases, and your return also increases. So if you are an aggressive player, you can choose to take the benefit of margin benefit, but I personally don't advise anyone to use it. Okay, so let's go to the third combination, that is 9:20, 9:25 and 11 o'clock trade. Now the margin required is same. Why? Because this 9:25 trade, right? This trade will exit before this entry. Okay. Now what is the return on this thing? 258%. Now how much it increased by? It's like it's increasing from 232% to 258%. Now you see your return is increasing, all right? But all these numbers are also improving. Now your risk to reward is improving. Okay. This okay. In this case, the maximum drawdown has increased by like 2% or something. Okay, but your expectancy has increased. Why? Because your win rate has improved, your risk reward has improved. Like every day you will be making smaller losses. Okay, so let's go to the fourth combination. The fourth combination is 4 lakh rupees again, because all the trades after 925 are one after another. That is, I call them as cascading trades. All right. So what is the absolute return in percentage terms? It's 295%. Now what was the return for the first strategy? It's 339%. So just remember that figure. I'll just write it somewhere. Okay, I'll just write it here. 3. Okay, cut. It's 339%. Okay, so what's it for the fourth one? I think fourth. Okay, fine. Let's explain this again. So it's 295, and the maximum drawdown has started to come down again, but the expectancy has started to rise. All right. So let's go with the fifth one. Okay. Again, the maximum drawdown has increased by a little bit, but your expectancy is rising. Why? Because your win percentage is going towards 70%. Also your risk to reward is improving, like from like 1.04 to it has become now 1.2. Okay, but you have to also consider the last column. Okay, this charges. Now the charges are very high because for the same margin you are, and this charges is not like for 1 year or something. It's like for entire period of 7 years if the current charges regime was there. Okay, so I mean, but you are making like 13 lakh rupees. Out of that, 3 lakh rupees is like going towards the charges if you are trading in a zero brokerage account. Okay, so let's go to the final setup, that is sixth. Now what is the return percentage here? It's 393. And what was the percentage return for the first trade? It was 339. Okay, now absolute return has increased. Win rate has become close to 68%. Risk to reward has become 1.3. Maximum drawdown has fallen to 6%. And trust me, this is the worst possible maximum drawdown I have taken for that particular system. Okay, it cannot go less than 6%. I mean, it can go, but that would be a very wild market. Okay, and the expectancy we have managed to bring it above 0.5%, which is a very good expectancy of any system. Now, let's clear the screen and let me show you in tabular form. Okay, I hope it's visible. Let's make it a little bigger. All right. So the combination one return was 339, and then there is a sudden drop here in 232% because the capital is doubled. Okay. So after that 258, 295, 344 and 393. Okay. Absolute return you don't have to look at, but the win percentage, it has gone up from 63 to 68%. The risk reward has gone up from 1.05 to 1.3. Maximum drawdown from 9.69 to you have come down to 6%. And the expectancy you have increased from 0.31 to 0.56. Now the thing is, you can keep on adding these trades, okay, and make different combinations, and somehow try to find a sweet spot, like what is your targeted expectancy and targeted. You can tweak around with these data. Like I have kept a random 100% stop loss for 920 trades. So that means that if on a Tuesday or a Wednesday, if 100% stop loss is hit, you're no way going to be making profit on these 920 trades on Tuesday, Wednesday. Okay, but still I have kept 100%. I don't know why, but I like to keep 100%, so I kept 100%. Now 920 on Monday, it is less percentage terms, because Mondays are mostly directional, because it has to, it has to absorb the 2 days news that is there in the world. So it will either go up or down, and if it goes like small up small down, then both the sides stop losses will be hit. But don't worry, because these trades are still remaining. Okay, if you like assume like on a Monday, if say suppose both the side stop losses are gone, okay, so 30% stop losses are gone on like 200 rupees, so it's like 60 points SL is gone in this trade. Okay, but these trades are there, and they will be able to cover those 60 points if they all work. And if they don't, you have a portfolio level stop loss at around 2% or 2.5% per day, or like, let's not go to 2.5, let's keep it at 2%. Okay, now per year return, as we can see, it's let's not consider these. Okay, let's consider these two values. Okay, so it's like almost close to, for 4 lakhs, it's 1,40,000. Okay, that is around 30%. That's very bad. Okay, that's very bad. But at this time, the margin requirement was also very less. Okay, in this 2017 and 18 period. So you can consider this thing. So it's over 50%. So over 50, anything over 50%, and this is, mind you, this is including the charges, because I have included a slippage in the calculations. Okay, so I hope you got my point. Now let me just finally show you, like, how it's going to work in all the different types of market. Okay, so if the market opens here, and if it, just take this scenario, if it keeps going up, all right, so what will happen to your 920 trade, this 920 trade you took here, what will happen, that 100% stop loss will be taken out. Okay, but the 925 trade, 11 o'clock trade, 14:15 and 15 o'clock trade, all of these will be making profit and compensate you for the 100% stop loss that you have taken. Okay, now let's consider the second type of scenario, a absolute sideways market, or a perfect sinusoidal type of market. So what you take a 920 trade here, none of the stop losses of 100% is it, but you take a 925 trade here, put is gone, call is gone. Okay, another trade at 11 o'clock, put is gone, call is gone. Another trade, put, call, everything is like, all the guts are giving you losses, but only 70 points, and you're expecting the theta strategy to give you some money here. Okay, so, and the third type of market, okay, when you will bear the maximum loss, when the market is going up, okay, and then suddenly crashing down, and this thing is like 920, and 11 o'clock is somewhere here, somewhere here. Okay, so 920 trade, call gone, put also gone, and the theta trade 100% gone, 100% reversal to cost also gone. So in this, like, very big moves days, no, you will be making huge losses. But how many days have you seen these type of markets in past? It's like very rare, right? So in recent times it has been happening, but like, even on a budget day, on the budget day of this current year, what happened, it like market was sideways, it went up, okay, and then it fell down, then came up and stable. Okay, so on this day, what would have happened? So call sold here, calls SL hit, and here somewhere here the put stop loss at cost would have gotten out, because the premiums were very very high. Okay, but the 925 and the 11 o'clock trades would have made you some money, and 12:30 fell somewhere here, so that gave you the maximum profit for the day, and 1st of February would have been profitable as per this strategy. So I hope that I have made my point clear, like how you can design yourself a strategy. So all you have to do is that you have to now just go and uh, keep putting some random trades, and at some random time, and just take this point, like if even if you take this trade at like 928 or 929 or 950, whatever time you wish to take, this strategy is going to make you money. Okay, that is the whole point here. So and also okay, fine, this last point, on Fridays, you can see that I'm not taking any trade on Friday. So on Fridays, you can diversify into FinNifty. Okay. And if you have like enough time with you, you can do one thing. You can just replicate the same thing in Nifty. You can replicate all of these in FinNifty. Okay. And then backtest the whole thing and let me know the results in the comment section. Okay. So I hope I have made my point clear. If you want like more videos like this, you can just comment that yes, you wanted something else or extra. So I'll be coming up with some not I will not be giving you the strategies, okay, but I'll somehow try to train you so that you can find a strategy for yourself. Okay. So that's all for today. Take care. Bye bye.